Hi, everyone. Good afternoon. We'll just let everyone connect, and then we will be kicking off today's State of the Nation webinar. Okay, great. I think we've got lots of people connecting, so let's go straight into it. So welcome, everyone. My name is Helen Muzzard, and I am the CMO for IAB Europe, and I'm delighted to host today's State of the Nation webinar, where we invite our chief economist, Daniel Knapp, to provide his latest economic outlook for the digital advertising industry. As many of you are aware, we host these webinars once a quarter. Typically, we have about a 30-minute presentation with Daniel, and then we'll be having an audience Q&A. So for the first part of Daniel's presentation, he's going to be sharing his economic outlook so that we can see whether he is going to be updating his prediction for 2023 growth. Afterwards, he's then going to be looking at growth drivers for Europe in 2023. So there will be lots of opportunity to ask questions to Daniel at the very end. As we are live, please do put any questions you've got into the Q&A box, which you can find in the middle of the screen. Okay, so let's check Daniel is actually here. Hello, Daniel.
Hello, everybody.
Perfect. Welcome. I'm going to hand straight over to you, Daniel, and I will come speak to you at the very end.
Fantastic. Thank you, Helen. Hello, everybody. It's the Economic Trend Forum time again to inspect how is the digital ad market in Europe shaping up, what has happened in 2022, what signs can we read from past company results for future performance of those companies in the digital ad market, and which broader trends, economic and also structurally in the digital ad market, are going to affect the market. If you could kindly let me to share my screen, then I can also share the latest stats. Thank you very much. Post. Fantastic. Here we go. Right. So for the next 25-30 minutes or so, I would like to provide you with an update on the digital ads landscape in Europe and what that means for us. And there are a couple of aspects of this presentation. Firstly, I'm going to speak about how the overall economic environment is shaping up and how that might or might not change our forecasts and the optimism we have in digital advertising. Secondly, I really want to dive in more on how is the structure of companies thriving in this world, who's growing and who's not growing, how is that changing, how's the ecosystem changing. Then I want to dive into some of the growth drivers that we're going to see, such as retail media, CTV, but also what that potentially means to publishers, dive into the changes in the programmatic market that we're currently seeing. The latest ISBA PwC study was recently updated, so there got quite some new insights that we can extrapolate from that. And also we saw lots of announcements from cloud services to companies like Criteria looking for a buyer, ChatGPT and so forth, which also more downstream are going to probably affect our market. So those are the things I want to speak about today. And then please record your questions and we'll have a lively, hopefully, Q&A afterwards. So for many marketers, I think when we entered 2023, it felt like a Dutch bicycle race. And this isn't just any bicycle race. These are the Dutch headwind cycling challenges. And you can see on this picture how the cyclist is battling against the wind. This is a race that is done every year once when there is at least gale force 7 winds roaming across the Netherlands. And the good news here is that, yes, while we might be feeling like this, it's really gale force 7 at least, there is movement. The bike is moving, and we believe that digital advertising will also move forward, i.e. grow in the future. So let's dive in and understand a little bit what's the macro picture, what has changed. With our last ETF, Economic Trends Forum in December, And since then, the IMF, the World Bank, and others have provided new economic outlooks. We have new data from Eurostat and others, which will help us understand a little bit better how our consumers feeling, how business is feeling, and what might be the read-through on digital advertising. So first of all, when we look at the revisions of GDP forecasts, this is the real GDP forecast revision by the IMF from October 2022, which we ran off last time, versus January 2023, where we run off from now. And you can see quite a few changes happening here, and they really fall into two buckets. I ranked this here on actually 2023 revisions, and we got a major downward revision in 2023 for the UK. This is a kind of revision in percentage points. Also a slight downward revision for Spain, nothing happening in France, kind of neutral, not changing outlook. But then we see several countries have actually received upgraded forecasts, and notably also the Euro area, and a strong economic outlook update for Italy, and also emerging and developing Europe, which is everything they count as Eastern Europe, and that includes Russia. So outside of Russia, excluding Russia, the upward revision would actually probably have even been higher, despite the surprise of a Russian GDP performance that some of you might have read in the news. So two different pictures, some downgrades, but a lot of upgrades. And this actually means that if we look at the actual data, so the January 2023 forecast of real GDP, that the Eurozone, where most of you are residing, is going to avoid the recession. This doesn't mean that a recession is not being felt by consumers through rising prices, energy costs, rent, and so forth, but that in real terms, the Eurozone will avoid this recession. You can see some of this narrowly escaping it, such as some of the largest ad markets, the largest ad market on the European continent, Germany, with essentially flat growth, and then kind of more improvement in other markets. But the UK, which is the largest digital ad market in Europe, with around a 40% share of overall digital ad spend, is going to face a recession. Now, the good news is we know that although advertising spend correlates with economic growth, we have seen in our forecasts during the pandemic that it's not a linear correlation. And we know that advertising has other motivations and drivers than just looking at the overall economic growth. So this is a good indication of what's happening, but it doesn't necessarily mean that advertising is going to react one-to-one on this. I think the UK, an interesting highlight here from Goldman Sachs, is that the UK recession is actually going to be nearly as steep as the one in Russia, as we can see here circled. So there is some uncertainty, I think, about the UK. WARC has just issued a new forecast for the UK, predicting growth in nominal terms, but a contraction in real terms. And I think that's a fairly realistic forecast that we would echo and actually see the UK not outperform any more than it did in the last 5 years or so in terms of its peer group of European ad markets. The good news is that although we have seen rampant inflation, the latest Eurostat data is showing this is kind of headline inflation. We are seeing that inflation is peaking and will decelerate. So this is at least a small boost for demand going forward. What we can also see, despite rising prices, despite inflation, that employment levels are a good indicator to suggest whether consumers are going to continue to spend or not. We can see, if we look historically here, this data from the OECD, the unemployment rate as a percentage of the labor force, and we have seen this, of course, go up during the pandemic, then decline afterwards. Now it's going up slightly, but what we can see is that if we leave the kind of UK aside, that in the euro area at least, we're going to see, even throughout 2023 and 2024, a flat unemployment rate, i.e. it's not growing. For many companies, letting go of employees and rehiring later has often higher costs than keeping them on. And just the fact that employment levels are fairly robust suggests that consumers are going to spend. Of course, averages are not a good predictor, as I said in my last economic update, but we can see several pockets of consumers not being affected much by the rising prices. And this is going to mean that certain segments of consumers are going to prop up the ad market overall. We can also see that at least the perceived outlook in the EU is improving moderately. What we can see here is what's called the Economic Optimism Index, and it has been far from optimistic of late, as you can see. I think it's an interesting indicator because it combines, it's a blended rate that combines consumer confidence and also business confidence, service provider confidence, retailers, and so forth at certain weights. And of course, advertising is a function of supply and demand, and we need to take into account both what consumers feel, but also what businesses think is possible. And I've zoomed in slightly here on the latest months of this index. We have the data now until the end of January, and we can see that optimism really was most muted during the end of Q2 and end of Q3 and Q4 2022, and we're seeing a slight uptick. Let's see whether this persists, but this is moderately good news as well. Overall, what we're seeing with the rising prices, I think more potential for consumers to shift to ad-spended services. We can see the US here as a bellwether. There's an analysis from A.T. Kearney. We can just see how many subscriptions people have, what they spend these subscriptions on, and also how much they spend on average on subscriptions. And there is a widespread sentiment among consumers to lower those subscriptions. And we can see overall struggles and as for businesses. You might have seen the latest Disney results where they mentioned how unprofitable Disney Plus was, etc. So we can see, I think, in these trends here, greater attraction of ad-funded services to consumers. We've seen lots of headlines about job cuts, in particular in the tech sector, and some have suggested that this is a read-through to kind of general weakness in the sector. But I think they make good headlines, but are not necessarily a good indicator. And what we can see is many of them are mainly a result of pandemic overhiring. What I've taken here is the Amazon corporate jobs, so not warehouse workers, etc., but those actually working in corporate functions, and how this has grown over time. And recently, Amazon announced that they were going to cut around 18K corporate jobs. But if you look at that, status quo then Jan 2023, that is still 25% more than at the end of the first year of the pandemic. So we still remain at relatively high levels. This is more of a correction than a cause for panic and overall weakness in the tech sector, and more broadly than digital advertising and the underlying business. But overall, what we can see is a trio of trends within ad spend. Some spend is evaporating. We can see crypto collapse, but I think this is mainly look at it in the US. We did some analysis and found that crypto, although they're spending a lot programmatically on social, in search, it's actually a much smaller proportion of spend in Europe than it is in the US. We can see some B2C businesses like Made.com in the UK shut their doors. So this means that spend evaporates. We're seeing some consolidation, for instance, Gorilla, Getty a deal, which also means that some spend is going away in the last mile delivery segment and all those businesses that were fueled during the pandemic. ATT has an impact. We'll come into that later, and you can see that at the bottom here, I think it was a good indicator that Eric Seufert stated in his blog that the payouts to developers from Apple actually remain constant between 2021 and 2022. There isn't really much growth happening here. Autos potentially deferring spend as supply chain issues persist. And others are adjusting spend, saying that we want to be more digital, we want to be more efficient and more effective. And you see that in particular in the consumer packaged goods industry, where we see shifts towards digital. So the current climate is an accelerator to structural transformational trends which will benefit digital advertising. And if you look at recent company results, you can really see this kind of push and pull happening all the time. Uber announced results recently, breaking out the digital ads business, mentioning that positively with extremely high growth, now having around $500 million ad spend. We saw some of the, if you look at the Alphabet results, some business lines were down in nominal terms. YouTube down in Q4 7.8%. If you put in inflation, it was nearly flat. Similar things at Meta, where the nominal results looked worse than in real terms if you account for strong dollar inflation and so forth. But also some other signals saying that the signal loss is actually providing quite a few headwinds. So that means that, talking about signal loss, that initially, and I mentioned that in my last outlooks, that we were still waiting for economic headwinds to really hit. And what we saw in a lot of businesses was actually a decline in ad revenue due to the signal loss, due to lack of targeting, etc. And we can see this clearly, for instance, back then, Lotame in April 2022 predicted a revenue impact. We kind of saw, interestingly, Criteo in their results just very recently for the full year 2022 quantified the signal loss impact on their business at $60 million. And even companies that shouldn't really be affected by signal loss now on the right side are seeing some headwinds, at least weakness in demand. And in a sense, those who produced those signal loss headwinds, Apple, in their financial results highlighted that they are seeing weakness in digital advertising. So that means we're moving now from an ATT recession to, if we read through company results, some general macroeconomic weakness, which is affecting digital advertising spend. Overall, as I said initially, digital advertising doesn't necessarily move a one-on-one in a linear way with GDP, but we do have a strong correlation, which we can't discount. So here we looked at quarterly data, quarterly ad spend overall in the UK, and analyzed and correlated this with quarterly growth in GDP. You can see some outliers here at the bottom left and at the top right. These are both quarters in the pandemic. But if we would remove them, the correlation would even be stronger. So we can't fully discount these economic headwinds in our spend projections. Aggregating what recent forecasters have said, we see a bit of variation between forecasters, in particular, whether you're operator or observer in the ad market. We see agencies having, as active market participants, having a fairly consensus view on global ad spend growth. We're seeing WARC being a bit more pessimistic, and then we're seeing the equity analyst at Arete having the most pessimistic view. The key question here is always, are these nominal rates or are these real rates? And Dentsu made a very important statement in their outlook, publishing the outlook in nominal terms, but highlighting that actually if we adjusted this to constant prices, growth would actually be much slower. Here, of course, globally 3.8%, you see in the statement here, it's a bit lower, but because this is just the top 12 markets. And we see something similar. So we think in nominal terms, we maintain our forecast for digital ads. We don't see any necessity to change as we factored in the Q4 results. We think that digital ads in Europe are going to grow by 2.1%. But this is, of course, in nominal terms, which means if we adjust for inflation, which luckily is going down in 2023, the digital ad market could actually face a very moderate contraction. Now, with this macroeconomic situation, lots of structural things are changing within digital advertising. And I mentioned some of the company results where, for instance, Uber was growing, Amazon was growing, and we saw some weakness in Alphabet, in Snap, and Meta, and so forth. This opens up, I think, a broader question to, are these just short-term impacts of very mature businesses, where we get the ceiling of kind of social adoption or just very large businesses, or is this a long-term move towards a more multipolar world of digital advertising? I think this debate among industry commentators was partly sparked by a recent article in Axios using inside intelligence data for the US, showing that the combined share of Meta and Google of total US digital ad spend has declined over time, but actually since 2017 already, that share has been growing down, as in particular e-commerce, but also to a more moderate extent, streaming have accelerated. A couple of things behind this, of course, behind this hypothesis. Was it happening? Yes, there's the signal loss, there's market saturation in terms of social. We're seeing commerce players offering closed loop attribution. We're seeing ad networks growing, new networks being launched. We're seeing players like Walmart, Amazon, etc., grow extremely fast. So in the US, we have much more scaled businesses in the retail media space than in Europe, with Walmart making over $2 billion already. This is a far cry from what most of the European players make, where I think the largest is just shy of around 100 million euros. We're seeing the move of TV money to streaming, and also the increasing verticalization of search, i.e., if you look at mobile search on Apple, if you look at product search on Amazon, etc., this also drives this multipolar world. The key question that we had when we looked at how is the market changing in Europe is whether we can say something similar about Europe. Do we have an end of the duopoly in Europe? Are there more players who can thrive, who can grow, or is it not the case? And of course, historically, we've seen that few large players outperformed the overall digital ad market and have grown share. Is this the case still, or is it changing? We try to figure this out and assess the European situation. We have some good reference data to start with. We have our annual ADX benchmark study, which many of you are familiar with, which is a meta-analysis of European ad spend. 28 different markets. The national IABs supply us with ad spend data from their markets, and we harmonize that data. It's a, in a sense, best informed guess of how large the digital ad market is, because the methods, the way of calculating this, they vary between IABs. And there is the problem that many ad forecasters have, many ad analysts, how to actually account for the long tail of ad spend, not going through agencies, things that aren't reported and captured by surveys. So in the first step, what we did is we removed all of the reported data on search, on social, on YouTube. And also we estimated how large is actually the Google long tail network revenue that is not accounted for in the national IAB studies. We then looked at the SEC filings of the large players, took that data, converted it into euros and kind of in constant currencies, and then added estimates based on these company reports, and also modeled out Europe when Europe wasn't fully disclosed by business line, which for instance isn't the case for the Google business, where we only have an overall share of total revenue for Europe. So we modeled this. This is preliminary, and it means that overall we're expanding the size of the market. We captured kind of nearly 100 million in the ADX benchmark study, but with this kind of increased view, we added around 10-15% to the market. So it means, in conclusion, that also in Europe, to a smaller extent, at a slower pace, we can see a multipolar world in digital advertising emerge. So we had, I'm breaking out here, Amazon, Meta and Google as an aggregate, and then other. And this captures display, search, audio, classifieds and directories, and within display, we got native, and we got banner, and we got video in there as well. You can clearly see that the share increased again during the pandemic as advertisers switched to performance-based models. So we didn't really see this continued decline in shares as we saw in the US. We actually saw an increase during the pandemic years, but then a downward correction in 2022, not to the 2019 levels, but regardless of that, a downward correction to nearly the same percentage. Amazon was growing, the other share also growing and being nearly back to higher than in 2020, and well, not yet back to 2019, but getting there. We expect these trends to continue, and we'll continue to model this out. What this means is I looked at then, where did growth come from in Europe? When we take a segmentation in this way and model which companies, which segments in the digital ad space grew, we can see something interesting. We can see massive growth in TikTok. We saw strong growth in Amazon. And then we saw a Snap, of course, also still growth, Meta and Google down, other social also down, largely impacted by, of course, Twitter. But remarkably, in the middle here, not far behind the Amazon performance is an other segment. In this other, of course, all publishers. In this other segment are retailers. In this segment are broadcasters, other CTV providers, and so forth. So we can see, even if we factor out not just the duopoly, but even Amazon and some fast-growing platforms like TikTok, we saw strong year-on-year growth for another segment. And it's not as strong as in the US because this other segment is still much smaller than in the US. And we can see, of course, in the US, a large part of it is already retailers and other commerce media platforms outside of Amazon. What we can look at here is that Europe really lags behind in this, meaning there's a lot of headroom to actually further increase the share for these other segments in the years to come. What we look here at is how big commerce media or retail media, including Amazon here it is, as a share of overall e-commerce revenues generated in that market. We can see that leading European markets like Germany and the UK are more than double behind actually what's happening in the US. And if you look at the European average, it's much lower. So there's a lot of headroom if growth continues in the retail media segment. And we come to that in just a little bit in this presentation. There's further headroom for this multipolar world to emerge. Also in the US, we've seen strong growth and large revenue sizes in CTV, but this isn't necessarily the case yet in Europe. We see very different structure of the TV market, very different, a much more demand-driven market versus a supply-driven markets, inventories traded differently, etc. So we looked at some eMarketer data for the US in terms of how large is actually CTV versus total digital ads. We did some models in Europe as well. So the 120 billion euros for digital ads in 2022 is our new estimate, based on in a sense, an expanded ADX study that captures the long tail, as I mentioned before, and also an extrapolation growth rate 2022 versus 2021. And then for CTV, we took as a reference a Spark 90 study in the UK, which in a very convincing and methodically robust way, analyze and split out the CTV revenues in the UK, which include broadcasters, but which also include YouTube, plus smart TV manufacturers and others. And then we understood how large is the share of the UK, what are people in other markets saying, and we got feedback from agencies and others for some of the top 5 continental European markets, and extrapolated this out to further European markets. So we arrive at an estimate of around 2.4 billion euros in ad spend. And this means that, talking about a multipolar world, CTV can relatively, through streaming services, contribute more to this multipolarization of the world. Currently, 8.5% of overall digital ad share, versus in Europe, that share is much lower. Meaning, if that CTV market, if in particular long-form video growth also continues at a faster pace with more potential for this multipolar world, but if the CTV and the overall digital video market is being held back by market fragmentation, different standards, HbbTV versus IPTV and so forth, we can see that we won't be able to realize this the full potential of that as in the US. But overall, we can see that advertising is going to become a major driver for the total video economy. So online video overall set to outperform all other ways of monetizing through video, be it through linear television, paid or free, or through online subscription services. So this should provide some potential for scale, although Europe, as I mentioned, lags behind this growth, both in the US, looking at the US, but also APAC, and the fragmentation of the European market into very national closed ecosystems is a key issue behind this. I mentioned retail media as a driver, but I think it's important in 2023 to do a retail media reality check. Overall, I think there's more evidence that retail media is more than a hype, and its potential gets confirmed by new sources, not just the Uber results, but also if we look at the recent agency results. On the left, we can see our fairly bold prediction in October 2022 that retail media has the potential to top TV ads by 2026, and this is linear TV, excluding BVOD-enabled services. And just a few days ago, the Publicis CEO actually stated on the earnings call that CPG companies would spend more on retail media than on linear TV by 2025. So it's qualifying this, and it's primarily a US market perspective, really showing the potential. But with forecasts, they are not a confirmation of reality, but they show what is possible in theory if the market continues to develop and innovate its products and solutions. And here we are running in a bit of a problem in 2023. The market for retail media in 2023 must get ahead of fragmentation to really see this potential. We did an analysis and saw that there is actually a lot of fragmentation coming into the market as more and more retailers are launching their online retail media offering. We track around about, I think, 150 different retailers in Europe, and we analyze just in a binary way. First, do they have a retail media offering, yes or no? And then we look at how mature is that offering based on what services they are providing. And just counting how many have an online retail media offering, we saw large increases from 40 retailers in our database in 2020 to more than double that in 2022. So lots of new inventory comes in the market. But the ANA in the US just a couple of days published an eye-opening study on the state of retail media, which highlights some of the challenges that buyers are facing with retail media. And as you can see, when you look at not just what is a challenge, but what is a big challenge, the walled gardenization, i.e. everything's closed, but also the fact that there is lack of standards is holding the market back. And we think this is a huge issue in Europe as well, which needs to be resolved. So number one, we're seeing 2023 a year where we must tackle this lack of interoperability and lack of scale. We don't have a single Walmart, but a lot of mid-sized and small retailers in Europe with all their micro walled gardens, etc. So this needs to be addressed. We often see spend is still coming from a small pool of endemic advertisers. It's not being opened up. We can see that programmatic on-site often is in its infancy. A lot of deals are being done as a managed service or as on an IO basis. So really tapping into the wider market demand, like publishers are doing, isn't really established yet in Europe. Also looking at, for instance, DSP and SSP deployment by retailers, this often isn't the case yet. So a lot of potential there to close this gap. Also what the ANA study found, and also what we hear in some market checks, is that advertisers, while they want to buy on retail media, they often feel they are in a must-buy situation with their partners, i.e., where kind of deals that they have on trade deals are kind of then layered on into retail media ad spend, etc. So which we tell to choose freely, and also how to set up proper measurement to assess performance and orchestrate across them is still in its infancy. Also increasing pressure to combine online and offline, which isn't really happening yet, and also online omni-channel, i.e. retailers themselves don't want to be seen as in a sense the bottom of the funnel solution, but we are seeing with still limited success in moving out of that situation. Lastly, there's a lack of clarity still, more so in Europe than in the US, both on the advertiser and the agency side, who buys, how teams collaborate, etc. So this is a huge task for the market to tackle this year, also with respect to the potentials of this multipolar world. I think what we're also going to see in this multipolar world is increasing, I call it the appification of digital marketing. An economic environment which is facing headwinds, cost cuttings, and efficiencies is kind of suited to that. And at the same time, we're of course seeing through signals, the rise of clean rooms, etc. More movements in this space. And let me illustrate what I mean in a second. What we can see overall is that corporations are trying to rationalize through digitization. They create efficiency through the digitization. And we believe that this will create a long-term fuel for digital advertising. What you can see on the left of this chart is the recent Gartner estimation for full year 2022 globally on how much corporates are spending on IT services. You can see the software bucket is extremely fast growing, and also one of the largest buckets. In that you have cloud solutions, you've got marketing solutions, and so forth. And we see that increasingly digitization strategies and rationalizations in marketing are either coming out of similar or same budgets or are being interconnected. And many market commentators, let's move to the right side of this slide, have for years said that digital ads and marketing and cloud services are going to become much more integrated. I think a watershed moment for this was the AWS clean rooms announcement in Q4 2022, potentially allowing clean rooms in minutes to reduce the cost and the time of deploying clean rooms, with many external partners as well, or also other clean room providers jumping into this. And that means that kind of overall, if we look at some data from the recent CMO survey, which is a global survey of CMOs, their attitudes and expenditures, and overall corporate budgets are flat. The proportion of spend that is going to marketing is increasing. It has increased in the last 2 years and is going to continue to increase. And this relentless drive for efficiency that we're seeing for digitization is going to have a positive impact mid and long term on digital advertising. But it's not just the cloud service providers who will benefit from this. I think midterm, this is going to be good news for everybody, because while a lot of these services initially are about digital activation and kind of lower funnel things, at the same time, digital ads with audience fragmentation, digital ads need to address more marketing functions and channels over time. So there's a huge potential to link the data-rich environment that we're going to have in digital with the corporate efficiencies around digitization. I think this chart here shows what I mean. Here, this is a longitudinal view of our AdX data, where we put ad spend in 3 buckets: display with banners and videos, also audio in there, classifieds and directories, and then overall search, be it vertical search or horizontal search. And we can really see when we look at the market shares, several distinct periods in digital advertising. So we're already, in a sense, talking about the history of digital advertising, where we had a period of performance display, in the beginning, then fueled by the Lehman crisis and the financial crisis, financial crisis, performance search coming in, increasingly then with the rise of programmatic, social, and the increasing share that overall that digital ads got of the marketing pie, an expansion into other more brand building formats. And now we're seeing also at the same time concurrently happening the verticalization of search. So more digital ads need to solve for more marketing challenges in the organization. And we believe that this kind of integration with IT services is going to create a nice tailwind for digital ads. Within those tailwinds, we're also seeing shifts in the structure of the market, and in particular in programmatic. I think it's quite interesting to see this kind of bifurcation in marketers between, on the one hand, transparency and control, on the other hand, performance, often black box through new kind of efficient AI systems on the other, and the kind of programmatic open long tail being in the middle, increasingly being squeezed by these two polar opposites. What do I mean by this? The recent PwC ISBAN AOP study in the UK was published on the programmatic supply chain, a follow-up from the 2020 study, which analyzed, in a sense, how many intermediaries took how much money and how much working media arrived at the publishers. Previously, in the previous study, there was a so-called unknown delta of around 15%, partly influenced by lacking match rate and also influenced by, I believe, not always knowing what a DSP really charges beyond its management fee, but also kind of what operational costs it has from Triscari, the analyst and Economist, has done a fascinating analysis on this. But bottom line is that this delta has now contracted from back then 15% to 3%. I think this bodes well for the health of the programmatic supply chain, albeit for premium publishers. The study is UK only. But what we're seeing already is shorter and often more direct supply paths in the premium environment. And we believe that this is going to continue. And so we have a set of marketers, in particular savvy brand marketers who are strong in in-housing, who are reducing the number of vendors that they work with, they reduce the number of sites that they're working with, who are refueling a more transparent programmatic market where more control is possible. We still have the open programmatic long tail, and it's easy to do. It gets kind of scaled results very quickly, although they're sometimes questionable in terms of data and reporting, and of course where the ads run. But then on the other side, we also have now new products, for instance, by Google with Performance Max, and also Advantage Plus, the Meta product, where we can see AI-based optimization that fuels kind of creative, and also where the ads are running, on which properties, which frequencies, etc., which are the other end of the market, which are called the black box AI performance market. And increasingly, we're going to see, we believe that this programmatic long tail is being squeezed, and the programmatic market will become the more transparent market built on controls. And then we have in the other end the market that is built that is going to build on on performance products, on AI-based automation. This is also good news, I believe, on the left-hand side here for publishers, as we're seeing increasingly collaborations between publishers and retail media providers, also creating direct integrations. I think the UK deal, ITV with Boots and Tesco's, is a first example of that, i.e. building proprietary direct supply chains between different media. And also if you look at somebody like Otto in Germany, for instance, that has its own SSP reaching 95% of the German publishers, in many cases even is the 5th largest SSP in terms of revenue for publishers. So in that end of the market, we see a lot of innovation and potential for, with a shorter controlled programmatic supply chain, and the fuel in retail media to create benefits and boosts for premium publishers. And on the other, of course, there is then the issue about transparency. What does ROAS, what does performance really mean for a different set of markets? In the programmatic world overall, we expect shifts to continue away from the open market in this environment, despite the complexities of private marketplaces being difficult to set up, different to control, manage, and so forth. We did an analysis based on US data, based on some publisher data in Europe, then extrapolated to understand if we're taking out programmatic direct here, what's the percentage share of the open exchange versus private marketplaces. This includes continental Europe and the UK. We can see a rise of private marketplaces shortly muted by the pandemic, where it was all about performance. But we can see that the trend, long-term trend, goes more towards these private marketplaces, and we expect this to persist in the years to come. I think there are a few other trends that are going to shape 2023. Some have been actively discussed in the trade press and on Twitter. M&A activity, for instance, in the ad tech space, probably lots of consolidation around retail media, Criteo up for sale, lots of speculation who the buyer is. Some say Shopify, Trade Desk, others says Yahoo. It's going to remain exciting. A lot of talk about, secondly, the future of search and ChatGPT and Microsoft investments plus Google's launch of a competitor. I think it's far too early to say how this will impact advertising or shifts in the share of search. And what we've seen in terms of company results, or in terms of stock market shares, even a small shift in the search market can have wild results, wild impacts on the stock price. But for advertising, number one, we have extremely high costs for chat-based search products, 7 to 10 times higher than for the conventional search results. And also the question really is, how monetizable is this through advertising? Sponsored links wouldn't really work. Plus the type of queries that go into chat-based search. What's the what's the weather tomorrow? What's the knowledge-based questions? What's the capital? What's the capital of Indonesia, etc. And these don't really lend themselves well to advertising. So I think it's an interesting space to monitor, but the shifts in the search markets are going to be overhyped for the midterm. A big focus, I think, is efficiencies, not just through digitization overall that we saw on the advertiser side, but also how with creative optimization, with other AI-based services, agencies can be more efficient, creatives can be more dynamic, etc. So a shift away from focusing on extracting value in the supply chain from a kind of media margin perspective to different ways of innovating in the market. So those are, I think, three things which are going to become important in 2023 and beyond. Certainly not all. Many other things are going to impact the market. But I hope I could give you an indication today as to how we see the market evolving, what the good and exciting news are around the multipolar world and how it affects a few other structural factors in the market. We're going to continue to monitor this. Next economic update is going to come in about 8 weeks, looking at the latest company results and doing some revised projections. But until then, I look forward to your questions and a little debate right now. Thank you.
Brilliant. Thanks so much, Daniel. So we'll go straight onto it. So you have put down the same growth, 2.1% growth for digital ads, so no change since the last State of the Nation. To summarize very quickly, could you just highlight 3 of the main areas that you think are going to be fueling this growth? I know that the whole presentation kind of summarizes, but what 3 things do you think is going to be behind this growth?
We see video overall, with CTV being still small overall video, and increasingly it's long form video. Then some players like TikTok. I showed you the strong growth there, and then it's retail media plus Amazon. Okay,
and then going on to retail media. Good question here. How will the rise of consumers searching on commerce and retail platforms impact the ad spend on traditional search platforms?
I think it's going to be increasingly intertwined. When you look at the, I think it was very interesting, the recent Google earnings call, where they outlined in a bit more detail what their approach to retail media is. So instead of launching their own retail media offering, using search and product recommendation to drive traffic and drive leads. So the nature of search is already changing due to the rise in commerce and the rise in retail media. We think it is symbiotic and not substitutional. Also bearing in mind that retail media ad spend is not exclusively on site, i.e. on the owned and operated properties of retailers, but that one of the largest opportunities is actually off-site. So audience extension, driving traffic, driving purchases back to the page, for which you do need search.
Okay, and then just quickly, last one on retail media. So you mentioned fragmentation as a barrier to realizing the potential of this growth, which is very similar to CTV. Question here, which channel do you think will break through first in terms of trying to achieve scale?
I'm more bullish on retail media, just because of the national nature of the CTV market, the often very supply-driven and supply-controlled TV BVOD markets in Europe, and also because, of course, with the richness of the first-party data, we can see migrations away from social. So large budget pools being in play, plus also net new money coming in through trade marketing, which overall means that this is going to be in Europe a larger opportunity.
Great. And then on the subscriptions, you showed, I think it was at the very beginning, how many subscriptions that consumers are willing to undertake. Question here about, do you think new ad-supported platforms like Netflix will shape this in a different way? Will we see the demand for subscriptions becoming even smaller over time as people become much more reliant on kind of ad-supported platforms?
I mean, we saw a subscription bonanza overall during the pandemic, not just in streaming, but overall in media and also beyond media. I think when it comes to Netflix, the jury is out. You've all heard kind of feedback from the market of high CPMs, of campaigns not necessarily not always having been able to deliver. So I don't think it's going to have a large impact for now. Many are speaking about fast channels, which is driving some growth in the US, but the question is how big really is the ad opportunity there, with live programming, often with series reruns, and also of an extremely fragmented market in Europe. So when it comes to audiovisual growth, although fast channels are growing, I don't see them as having a sizable contribution to overall audiovisual ad spend growth in the midterm.
Okay, and question here, where do you think the ad tech companies will sit in the advertising predictions?
That's an interesting one.
Yes.
I think that probably merits a webinar in itself. I mean, I think a few key things. We still have a vast array of different ad tech companies competing for the same amount of money. We're seeing take rates under pressure. We're seeing that the shift towards private marketplaces also is a squeeze on margin. And we're seeing that apart from a few, many are not yet deeply integrated into the retail media play. So we see more partnerships. I think the Criteo Magnite one is interesting, is something to watch. We're going to see more curation, or kind of building, in a sense, also hedged walls on the ad tech player side. The Trade Desk with its Open Path initiative, or in general, having tighter supply chains. But we're seeing also in some cases if we look at Google, for instance, the outsourcing of some of the client management to third-party providers. So be it Mighty Hive or others. So I think those service providers around ad tech are going to be well positioned. Now, it might be that some have predicted some of the larger retailers in the US are going to snap up a smaller SSP. Maybe Uber is going to have a play here, as some have said. That market, I think, remains quite interesting. If you look at the share prices, most of the kind of ad tech share prices are far below the IPO price. So I think there's some deals to be had. Lots
of potential out there. Completely agree. Question here actually around audio. So as per the 2022 ADEX report, audio is the fastest growing digital channel. Do you expect audio to have a significant influence on overall growth figures in 2023?
Yeah, that's a good question. We expect audio to continue to grow, indeed. Also at a double-digit rate. However, the market is still small, so it won't have a large impact overall. We expect, top of my head, the latest estimate we had for the audio market in 2024 was around 1.3 billion euros. So that's digital audio ads. This is a drop in the ocean, looking at the overall digital ad market being larger than 1 billion. So 100 billion, sorry. I think, but what's interesting in audio, though, is that there's a shift more towards streaming than to podcasts. You saw Spotify changing its podcasting strategy and moving away from original productions. There was a lot of ex-Hollywood kind of TV producer types trying to make the next podcasting blockbuster.
I think they said it's almost the end, isn't it?
Yeah. The blockbuster concept doesn't really lend itself to audio. We're also seeing that although podcasting growth was nearly twice as high in the last years as audio streaming growth, the monetization opportunities in podcasts are limited, as they're often only being listened to once and are hard to find. So we're seeing, I think, more of a shift towards streaming monetization in audio.
Okay, and just on that, the same thing, obviously, you talked around audio, they're just going back to CTV slightly. So just looking at the stats here, you are predicted to 120 billion for the total digital ad spend. You're equating CTV at 2.4 billion. How much growth do you expect over the next 12 months?
We are expecting around in the CTV space, and you subtract from the UK, probably around 25 to 30%.
Okay, it's huge. Yeah.
So there is growth. I think there is more scale. There's better measurement. There's more integration in buying platforms. The key question is, and this is hard. This is why I hesitated. Is we really tried a best guess to understand how large the CTV market is, but definitions of CTV vary wildly. And it's always a question: what do you actually include in it? Do you include some EPG banners in it as well? Or not. So it's actually a harder question to answer than it might appear.
Okay, and then just finally, I love the last bit that you talked about, some of the trends there. We're already, I think we were talking earlier on about, new one, right housing instead of in-housing, the end of precision marketing, attention, lots of different buzzwords coming up. If you've got to choose one buzzword for 2023, Daniel, what would it be?
Efficiencies.
Efficiencies.
It's a very accounting style type buzzword, but I think it's about efficiencies.
Well, let's stick to that theme and be efficient. We are 1 minute to, so I'm going to thank everyone for their time today. And thank you again, Daniel, for all of your hard work on the presentation. If anybody would like a copy of the stats, please email me. It's Mussard, MUSSARD, @ibeurope.eu, and we can get those across to you. In the meantime, have a lovely afternoon, and we look forward to joining you at the next State of the Nation webinar or one of our IB Europe events. Thank you so much. Bye-bye.